Numerous renowned retailers have been recently forced to close their doors due to the COVID-19 pandemic's long-lasting impacts and shifting client preferences. The list will just keep expanding. Analysts claim that companies like Disney, Bed Bath & Beyond, Amazon, and McDonald's are among the ones who face a great danger of bankruptcy as a global recession approaches and may follow in the footsteps of other businesses that have just closed down. Be sure to keep watching until the end to know why the 15 biggest retailers are closing their stores. Welcome back to Proactive Investing. Before we begin, remember to smash that like button, and to know more about the latest investing and economic updates, subscribe to our channel. Now, let's jump into today's video. Number 1. Disney. This massive brand earns money from several places, including its storied movie production firm, a slew of theme parks, and a lucrative streaming service. Still, more than a varied portfolio and a dash of magic are needed to rescue all of its stores. Early in March of 2021, the Walt Disney Company revealed that at least 60 Disney stores in North America, which offer apparel, toys, and other items based on its well-known films, would close down this year. Number 2. GameStop. Early in 2021, the troubled games retailer became a stock market and media sensation as ordinary investors began buying up stock in an orchestrated move to punish hedge funds that were betting on the chain's continued demise. While GameStop's stock price has risen dramatically, the company's future remains uncertain and will have closed over 550 US stores in the last 2 years as it shifts its focus to online sales. Number 3. Best Buy. The electronics company has been silently closing stores recently, with 20 closings scheduled for 2019 and 2020. In the year 2021, the company closed a higher number of outlets. Although the total number of store closures is not readily available, at least 60 Best Buy locations have likely closed. However, in November of 2021, the company announced opening a new experimental outlet stores in Charlotte in North Carolina. Number 4. Microsoft. Microsoft's profits skyrocketed due to the coronavirus pandemic as millions became reliant on its software for home working and virtual schooling. This has prevented the tech titan from reducing its in-person retail offerings though. In June of 2020, the company announced that all of its shops, including 70 in the US, would permanently close. Microsoft Experience Centers remain in former stores in London, New York, Sydney, and the company's Redmond campus in Washington, where customers can test their products. Number 5. Walgreens. Walgreens had around 8,800 locations open last month, but it is on a mission to close stores across the country. The company announced in 2019 that it would close 200 locations, and the 4 Walgreens branches in central New York closed their outlets in a month. Another area in Dunkirk, New York, will close its doors on the last of November 14th, while 4 more in Louisville in Kentucky will also close. According to reports, Florida, Colorado, and Massachusetts will each lose 1 Walgreens store before the end of November. Number 6. CVS. CVS announced last year that it would close approximately 300 stores per year for the next 3 years, bringing the total number of closures to 900. The move will result in a 10% decrease in CVS stores across the United States. According to Neil Saunders, managing director of Global Data, quote, "Too many CVS stores are stuck in the past with inadequate lighting, gloomy interiors, disorganized merchandising, and a weak assortment of products," end quote. The chain hopes the closures will enable it to invest into the remaining locations whilst growing its rapidly rising digital footprint. In Johnson City in Tennessee, in Fresno in California, and in Falls Church in Virginia, CVS has been gradually closing stores since the start of 2022. Closures will help create a, quote, "new retail footprint strategy aligned to increasing customer expectations," as quoted by a business representative. Number 7. Bed Bath & Beyond. Home goods giant Bed Bath & Beyond revealed intentions to eliminate 200 stores over the next 2 years, or about 21% of its overall store count, in July of last year. The company expected to save between $250 million and $350 million per year by closing the stores, which it planned to invest in remodeling its remaining stores and increasing online profits. Bed Bath & Beyond announced 37 store closures earlier this year as a part of its restructuring plan. The facilities spread across the 19 states shut down for the last time in February. On August 31st, the chain announced yet another round of layoffs. According to Reuters, another 150 stores are set to close as part of a latest business restructuring. In the first quarter of 2022, the home goods company reported a net loss of $358 million and planned to lay off 20% of its workforce, including CEO Mark Triton, to save its struggling brand. If you're enjoying the video so far, then please like this video and subscribe to Proactive Investing. Let's move on back to our list with number 8, Century 21. Century 21 announced in September of 2020 that it would close all 13 of its stores on the East Coast. The company declared bankruptcy after its insurance provider refused to pay a $175 million claim for business interruption caused by the COVID-19 pandemic. Century 21 lost insurance money, and very few business policies accounted for disruption during a pandemic. According to Fox Business, Century 21 announced plans to relaunch its brand due to customer demand. Still, the company marked its return by opening its first store in South Korea rather than in the United States. Number 9. L'Occitane. As part of the restructuring plan, the French beauty retail store announced in January of 2021 that it planned to shut 23 of its 166 US stores. Its in-store sales fell 56.5% between April and December of 2020 compared to the previous year's period, owing primarily to the pandemic. Number 10. Macy's. Macy's declared in February of 2020 that it would close 125 stores in the next 3 years before the coronavirus outbreak. Along with the closures, the department store behemoth announced eliminating 2,000 jobs to increase profits. Last January, the retailer published a list of 37 locations set to close in 2022, affecting stores in 19 states. Some of these locations would have been converted into fulfillment centers to keep up with the increase in online sales, which increased by 53% year-on-year in the second quarter of 2020, and then at a slower rate of 27% in the third quarter. Macy's announced earlier this year that it would close 6 more stores in Alabama, California, Colorado, Missouri, and Texas. Number 11. Gap. Gap, which owns the alternative clothing brand Banana Republic, announced in 2020 that it would close over 225 stores that year, with additional closures announced in 2021. The number of Gap stores in the United States was already declining, and the brutal sales figures caused by COVID-19 restrictions exacerbated the situation. In 2020, the company saw a 95% increase in online sales, which helped to offset some of the damage caused by empty stores. To meet the increased demand, Gap announced in February last year that it would invest $140 million in the construction of a warehouse in Texas capable of processing 1 million packages per day. Number 12. AT&T. Not only clothing, homeware, and pharmaceutical retailers have left the economic downturn. AT&T, the world's largest telecommunications company by revenue, also announced the closure of 250 stores and the loss of 3,400 jobs. The store closures were already planned before the pandemic, but the events of the 2020 pandemic accelerated the process. AT&T stressed that more store employees would be offered alternative work within the company, while others would receive severance pay of up to $100,000 and 6 months of healthcare coverage. Number 13. Pier 1 Imports. In February 2020, Pier 1 Imports went bankrupt and officially confirmed the shutdown of 450 stores. The company hoped to arise from bankruptcy as a profitable business, but that hope was crushed when COVID-19 struck, decimating the retail market. 3 months later, the company announced that all remaining locations would be closed as well, bringing the total store closures to 942. Number 14. Kroger. Kroger reported sales growth throughout 2020, including 14.6% in the second quarter. Despite this, the company plans to close 10 stores by 2021. The first was 2 QFC stores in Seattle and Food for Less in Long Beach, California. Many blame the district's new hazard pay policies, which demand the food retailers pay their employees extra because they were in the front lines during the pandemic. In Los Angeles, Kroger shut down 2 Ralphs and 1 Food for Less, blaming the closures on underperformance rather than hazard pay. However, only some were convinced, and 2 council members mentioned to investigate why they closed in April of last year. And due to poor performance, 2 stores in Illinois and 3 stores in Arkansas were also closed. And finally, at number 15, Carter's. Carter's announced in October 2020 that it would be permanently closing roughly a quarter of its stores, approximately 200 locations, because it did not renew leases on its less profitable areas. The children's clothing retailer is working to improve its digital business, such as online purchasing and curbside pickup. Still, it has yet to give up on the in-store shopping experience. According to Total Retail, Carter's CEO Michael Casey stated that the chaos caused by the coronavirus has created a buyer's market and that the company will look for suitable investments in future stores. And that concludes today's video. Which retailer did we miss? Comment down your thoughts below, as well as subscribe and hit the bell icon, and thank you for watching Proactive Investing. We will see you next time.